Hello and welcome to this latest edition of Courses on Demand brought to you by Forex Academy. So in this course, we will be discussing how to assess market conditions. Just before we begin and we explain what's involved in this webinar, please do take a quick moment to familiarize yourself with our disclaimer. Okay, so moving on then to our webinar outline. We'll start with an introduction to market conditions. We'll then progress on to looking at the three different types of market conditions. We'll have a look at the role that time frame, looking at different time frames can play when it comes to identifying market conditions, because it is quite an important one. We'll have a look at techniques that can be used to objectify market conditions. Of course, being objective in the market is a really important skill to have, and we'll look at that in some detail. We'll then have a look at the principle of a price cycle and how it can impact market conditions, and we'll finish this webinar with looking how to incorporate market conditions into one's personal trading plan. So we'll make it very relevant and very practical for you as well. Okay, so let's start with an introduction to market conditions. So before we define what market conditions means, it is important to firstly know that it is impossible for a trading strategy to work all the time. So, which is also known as indifferent market conditions. So the reality for profitable traders is that unfortunately losses are inevitable, and there is no getting away from that basic principle. Now, the reasons for this are often because every trading strategy or approach will be built on specific characteristics, which can from time to time contrast with the conditions of a particular market. So it's a case of certain approaches suitable for certain market conditions. And invariably, you will experience times where there's actually a clash between the market condition and the strategy that's looking to be adopted. So it's just important to take note of the fact that a trading strategy it's unrealistic to expect that strategy to work in every different type of market environment and market condition. So to give you a brief definition, this is the state in which a market trades. That's it in simple terms. Markets typically transition between states or different market conditions on a regular basis. It is important to note that each state or market condition possesses its own unique characteristics, which we'll have a look at shortly. Now, there are three different types of conditions which a market can experience. And I'm sure you're probably quite familiar with some of these terms, but they can be range-bound, are also known as consolidating markets. But they can also become breakout market conditions, which have very unique characteristics as well, and also trending markets. So what's important to take away is that they all have specific characteristics when it comes to the best time to buy or sell, which we'll be looking to discuss in some detail very shortly. So to just give you a very, very quick snapshot, looking at this first graph, we can identify what's called support and resistance levels on this chart with the blue lines, and we can identify that, or we can clearly see and identify that the market bounces off these levels, and it does so on a number of occasions, and that presents those that are range-bound traders. It presents the opportunity for range-bound sellers, traders, to actually sell the highs. So when the price gets up to these levels up here, they look for opportunities and see if they can sell these markets and drive price lower, and they do so on numerous occasions. So that's how a range-bound trader would look to capitalize and create a trading edge when they trade these markets. And the same applies for buyers when they look to trade these market ranges. So when price reaches a low, and there's certain characteristics which can be used to define a trading opportunity. But in principle and broadly speaking, they'll be looking for opportunities to buy at the lower end of the range and look to sell the market at the higher end of the range. So that's the approach a range-bound trader would look to take when trading a market like this. So if I take those arrows away, and we'll just move this along. So another type of market condition is referred to as a breakout market. Now, this is when you receive or you experience a certain confirmation to which suggests to you that this market is no longer looking to move and stay within a range. So what you find, and you need certain confirmation to actually make this as a trading decision and a trading strategy. But just looking at this candlestick here, you can clearly see we break through with momentum and we get a close beneath this level. And that is a little bit of a game changer for those that look to trade breakouts on this particular occasion. So what you will experience is it will provide an opportunity in this example to potentially look to sell this market to the downside. Now, the third type of market condition, to just sort of give you a very brief introduction to, is a trending market. And what's important to sort of take away from a trending market is that this just happens to be a bullish price trending market, meaning prices are pushing to the upside. And when you look at a price chart, you will notice that for a trend to be bullish, what you'll experience is often the price for the beginning of that particular trend to be very much towards the bottom left-hand corner of your trading screen. And if the trend is to the upside, what you'll often experience within that trend is higher prices on the right-hand corner of your trading screen. Now, there is additional characteristics which we'll look at in so much more detail very, very shortly. But to just give you a brief introduction and a general overview, you've got three significant phases. You've got your range-bound market, i.e. a market that clearly moves within a range. You've got your breakout markets, and you've also got your trending markets. And these different types of markets can present traders with some very interesting and very profitable opportunities. Okay, so let's take a look at these three types of market conditions in a little bit more detail. So firstly, just to look at range-bound market conditions and the fact that they do possess some very unique characteristics. So firstly, for a range-bound market to exist, you will need to see the market respect both a clearly defined level of support and resistance in the market and see prices bounce off those levels on multiple occasions. So just looking at this price chart and using this as a first example, we can work with what's called genuine levels of support and resistance, and you can identify those levels fairly easily. And what we can see is a clearly defined range-bound market, which moves from highs to lows and back to highs, and it does this on many, many occasions. And therein lies the opportunity for a range-bound trader to, like we've alluded to before, to look for opportunities to sell the highs at this top edge and look to buy the lows, which is the bottom edge of this particular range. So just another example to go through would just be identifying the price action. It'd be, again, looking to determine the range, and there's some specific characteristics that would need to be seen and achieved. But when we work with genuine levels of support and resistance, we can identify these levels relatively easy. Now, it's never important to be incredibly precise with the positioning of these supports and resistance, because what you can clearly see is the market respecting roughly that sort of level, and that gives traders some incredible opportunities to trade. So the conditions which are needed, the three conditions that need to be met for a potential for a range-bound market to actually be performed are as follows. So the first one is with regards to the move. So by this, what we mean is this market is clearly moving to the downside, and it creates an initial low. And that low is actually the first very, very important part of the formation of a range-bound market. So the second characteristic we are now looking for is actually with regards to the recovery point. And we just refer to it as a point because it does create a high in the market, having initially the move has been very aggressive and very bearish in this particular example, and it creates a low. Then we normally get a bit of a recovery point or a pullback on this market, which creates a recovery point. And that's what range-bound traders look for. So they look for these points and wanting the market to behave accordingly in and around those levels. Now, the third characteristics, which would be the characteristic required to effectively look to establish a range-bound market, would actually be the range-bound trade. So this is when your range-bound traders would look to identify. This would be effectively the first opportunity to identify an opportunity to maybe range-bound or range this particular trade, and look for an opportunity to actually look to push prices higher as far as this particular market is concerned. So again, that gives us some very, very useful information. And if we take it over to the next example, we can go through that same process again, except this time the move is coming from down to up. So we're now in a bit of a bullish market up till this point. It creates a high. We get the recovery point, which can be located at this level in here, and located at number 2. And as you can see, the price continues to behave around this level for a reasonable period before effectively we get our range-bound trade. So this is where your range-bound traders would look for opportunities to sell this particular market if they get an opportunity, and they would look to exit around the lower band. So whereas on the left-hand side example, a range-bound trader would be looking to buy this market and they'd be looking to exit at the top edge. Whereas in this particular example, a range-bound trader will be looking to sell the market at this point and looking to exit roughly around the lower edge. So it obviously presents some very, very interesting opportunities for traders, and that is effectively range-bound market conditions and how traders interpret them. So the next type of market condition we're going to look at is our breakout market condition. And again, these possess unique characteristics. So firstly, for a breakout market to exist, you will need to see an initial breakout of a range-bound market. So all breakouts occur from range-bound markets. So straight away, hopefully you can see the transition from one market condition to another. You will also need to see explosive momentum and volatility in favor of the direction of that particular breakout. So to just give you a little example, there's your support and resistance levels, and you can clearly see this market breaking above this level. We have the confirmation that we're looking for. We get the confirmed break. It's always nice to see the market come from a much lower position. It adds it and certainly gives lots of traders lots of time to look to try and capture this move when we get that breakout trade above that level, looking to drive prices to the upside. And that's what we've seen in this particular example. So it's very important that we identify the potential for a breakout, and we use or range bound levels to do that. And when we get a breakout of those levels, we can clearly see that we experience explosive momentum and volatility in favor of the direction of the breakout. So if we're breaking to the outside, we want to see a nice explosive move and look to capture that as a breakout trader. So that's one example. And to give you another example, this time to the downside, we've got a slightly different formation in terms of our range. So this is effectively a descending triangle. So it's actually creating a little bit of downward price pressure, looking to push prices lower when prices reach these levels. And of course, we get our breakout trade, which is what we'd be looking to do in this particular example. So the two conditions in this case that need to be met for the potential for a breakout market to be formed. The first one being the initial explosive move close, or the momentum close, should I say, above or below the range. So if this is our range to the upside, do we get initial explosive move to the upside? The answer is we certainly do. And in this case, it's above the range. And do we get continuation with a series of new highs in this particular occasion where we're getting this constant sort of pushing of prices? The answer is yes, we do. So this is a classical understanding of a breakout market, and it ticks those particular boxes. Now, with this trade to the downside, we're seeing exactly the same thing. So we're getting a confirmed close beneath, on this occasion, beneath the range low. So we ask ourselves, do we get that initial explosive momentum close to the downside below the range? The answer is yes, we do. And do we get continuation? Now, continuation can take a variety of forms. As you can see, we got a nice continuation, the following candlestick, and a little bit of a pullback before the market starts edging lower. So as long as it conforms with seeing an explosive move above or below the range, and you see that continuation, then it constitutes a great opportunity for breakout traders. Okay, and just looking at the final version would be looking at trending market conditions. And again, they possess quite unique characteristics as well. Firstly, for a trading market to exist, you will need to see an initial breakout of a range-bound market. So you will also need to see continued momentum and volatility in favor of the direction of the trend. Most importantly, you will need to see a series of what are called higher highs and higher lows in an uptrend, and lower highs and lower lows in a downtrend. So to explain this in more detail, we'll have a look at this particular example on the left-hand side, and to identify the fact that this market moves from bottom left to top right means that we are in a confirmed uptrend, pushing prices higher. However, you will also need to see periods of momentum and volatility in the direction in which we're wanting to trade. So there's numerous opportunities where you get nice green explosive candlesticks in this particular example, pushing prices higher, and that should look to give you more confidence to know that the likeliest response is for this market to keep pushing prices higher, as you can see on screen currently. And there's numerous examples of being able to see and identify that momentum and volatility in the direction of the trend, which in this case is pushing prices higher. And what you would also need to see is what's called a series of higher highs. Now, these are quite easy to identify. We'll refer to it as, in this particular example, HH. And as you can see, as the market moves it up in favor, we get to experience a higher high, and this happens on numerous occasions. So these highs are actually higher than the previous highs. And this is a classical definition of a trend where you constantly see a series of higher highs back to back. So in addition to higher highs, what you would also need to see is the market being supported from the downside. And what we mean by that is you will also need to see what are called higher lows. So we call these HL for higher lows. And as you can see, these higher lows will be printed in a similar fashion to the higher highs. But as the market pushes higher, we get a classical understanding of an uptrend, which prints a series of higher highs, followed by a series of, followed by a series of higher lows. So I'll just finish off these last few. And this is a classical definition of an uptrend. So hopefully that makes sense. And prices continue to push higher. So in addition to that, we'll move it along and we'll have a look this time at a trending market to the downside in this particular example. And again, what we want to see is, are we seeing the momentum and volatility to the downside, which is overriding the buyers in this particular example, and it's showing nice continued strength. Keep looking to flush prices lower so we can physically see the momentum and the volatility in this market. So that's the first thing. And we can see this as this market continues to drop lower. Now, the other characteristics we're looking for is, because this is a downtrend and we can identify it's a downtrend because prices this time are moving from top left to bottom right. And what we can see and experience is this market moving in this direction fairly consistently. Now, another very, very important characteristic of a downtrend is the fact that we will see it's the same as an uptrend, but just reversed. So we will see a series of what are called lower lows. So as the market moves, it'll print a series of lower lows on numerous occasions as this price moves in favor. And this again is a classic definition of a downtrend. But what you'll also get support preventing prices from pushing higher. And these are lower highs. So as you can see, they're higher the market, but they're lower than the previous levels. And again, you get a series of these printed. These are lower highs and lower lows as this market moves down. So this is a classical sort of definition of an uptrend and a downtrend. And as you can see, it's just the polar opposite of each other. Okay, so that's just a good overview of the three different types of market conditions. And we hope you can begin to identify and see the opportunities that this can present for different traders, whether you're range bound, whether you're breakout, or whether you are a trader that looks to trade the trend. So another important topic to look at when we're looking to identify market conditions is the time frame in which you are trading. So it's important to note that all market conditions are relevant to the time frame you are wanting to trade, meaning you might experience, for example, a range bound market followed by a breakout and a trend potentially on a 1 minute chart, which you may struggle to see, or you might struggle to identify with on a much higher time frame, for example, a 4-hour chart. Now, to explain this in a little bit more detail, let's share with you a live chart at the point of this recording, and I'll try and explain this in more detail for you. So just looking at this bit of price action, what we can clearly see, and this is a 1 minute time frame, and this just happens to be the euro dollar. But what we can see is prices trending to the upside. We're getting this sort of pattern where range-bound traders may be looking for opportunities to buy and sell within this framework. And as you can see, there'll be a multiple of opportunities potentially until something happens at this particular area. We get a little bit of a a breakout to the downside, and for that, what I might use is there's a level of support and resistance sort of sitting in this level, and you can see that the market clearly breaks through that level with a little bit of volatility coming into it, which could present opportunities for breakout traders to look for an opportunity to see if they can push this market lower. So this is just an overview, effectively, of maybe an approach that might be taken from a range-bound trader in a much smaller time frame. But look what happens when we increase the time frame, and a lot of that analysis can subside very, very quickly indeed. So now we're looking at a market which is clearly moving to the downside. It can be argued that there's some clearly defined levels of support and resistance sitting in this market, and this market is breaking out to the downside. We've got a little bit of a pullback back inside that level, so it's a slightly more convoluted picture, let's say, and all we're doing is straddling what we thought was a level of support and resistance, which it can clearly be defined as actually being relatively close to being a significant level of support and resistance. But as you can clearly see, the price action is bouncing above and below it. So now the view could very much be that this is very much a range-bound market. So those that look to trade range might look at this price action and identify some opportunities. But let's increase the time frame again and see what other information it gives us. So again, like now we're actually able to see a market which has bounced off a low. It's created a new high, and all we're seeing at the moment is a little bit of a pullback with some consolidation at this moment in time. Prices moving sideways for a relatively short period of time. And again, taking that analysis, so again, a range-bound trader might look at this price action and suggest there's opportunities to trade this range, and that would be down to the trader's methodology as to whether that's the case. And as we go through the different time frames, you can suddenly start to see kind of actually how choppy this price action really is, and that can give you some really useful information, because not only is there potential opportunities and they're much higher risk opportunities the lower time frame you go, they can be based on different rationale. So looking at this hourly chart, you can see that the market has been moving above and below this particular level of support and resistance on an hourly time frame for a significant period of time. And again, if we go up in the time frames once more, the picture begins to change. And now what we're looking at here is a pullback off the previous high, and this is a 4-hourly chart. And this is where your pullback traders or your trend traders might look to get involved in this market. So the breakout has already occurred. We get a pullback, and they might be look to buy the pullback in a situation like this. On a daily time frame, you can see what's come beneath it, which is a significant bull market. However, it must be addressed that market conditions can shift from one market condition to the other. So clearly, on a daily time frame, we are getting a bull market, but it has to be said that since, and we're looking at sort of mid-January, we have moved from a bull market into currently a range-bound market. So we're getting prices move above and below our levels of support and resistance. So therein lies the potential for different types of traders and the necessity really for any trader to be able to identify the market conditions, obviously prior to trading them. So hopefully you found that useful in terms of the importance of timeframes. It can really look to give you a completely different complexion and outlook depending on the time frame that you are looking at. Okay, so moving on to techniques to objectify market conditions. And this is really about a trader looking to remain objective as much as possible. And to just give you a brief definition, so what is objectivity? It is the lack of bias, judgment, or prejudice, and that can facilitate some significant benefits to traders. Now, the question we need to ask ourselves is, so how can a trader remain objective when assessing market conditions? Now, there is a couple of ways in which we can do this, and this is when technical analysts can come into their own, because they can use certain trading related indicators to help them remain as objective as possible when identifying these market conditions. And we'll go through 3 of them now for you. The first one is just identifying support and resistance, and identifying genuine support and resistance as well, normally on bigger time frames. And this will allow you to assess the market conditions properly. So when we look at price action like this, it's very choppy. We can literally apply a technique, and it's something that we've used in previous slides, and we've discussed it a little bit now in detail, where we're just simply looking to identify a top edge or a top edge range in this particular market, and a lower edge or a bottom edge range. So we're getting this market moving from highs to lows, and doing so in a relatively consistent manner. So when we identify these genuine levels of support and resistance, because that's what's happening, they're supporting prices at the lows and they're resisting the price from pushing higher at the highs, and that is what can give traders some significant opportunities. And as you can see at the mean, we have a slightly we have price action which is obviously slightly bearish to the downside, but very much moving sideways. And that's really what you would need to take away from price action like this, is that you are clearly in a range bound market. You have your range bound highs and lows, and the market is bouncing in between them. So if you happen to be a trend trader, this is not really the market conditions in which you would be looking to execute trades. So that's how support and resistance can be used to remain objective. And all you would need to do when using support and resistance is to basically acknowledge what you are seeing, and not psychologically talk yourself out of what is actually happening. So that is just a little bit about support and resistance. Another technique that can be used is a basic understanding of Japanese candlesticks, and of course this works hand in hand with support and resistance. So an understanding of Japanese candlesticks and their respect of support and resistance will help you with objectivity. So again, we'll have a look at this same chart. We'll identify those levels of support and resistance as in the previous chart, and we can see that price is slowly moving down, making lower lows and lower highs, but there's a gradual grinding to the downside. And what we can do is we can look at the Japanese candlesticks and the information they're telling us, which is that we are rejecting prices from moving higher at these levels, and it's doing so on a number of occasions. So that can give those that understand Japanese candlesticks a good opportunity to look to try and sell these markets at these levels. And as you can see in this particular example, they can do so on many occasions. And the same applies to the downside. So we can identify, if we understand Japanese candlesticks and how they respect and react with levels of support and resistance, all of a sudden we can we know this is a range bound market. And for those range bound traders, that can provide them with really interesting opportunities to push higher. The reasons why they can make these decisions is because they've got a comprehensive understanding of market conditions. And again, you can see the rejection to the downside. You can see the rejection to the downside on many, many occasions within these areas. And you can see the same again just recently. So your range bound trader would be looking for an opportunity to look to take this price back to the upside, and they'll continue to do so until this range, the market condition that we're currently experiencing transitions to a new market condition. So that's another technique that can be used to objectify market conditions. And finally, you can use a very basic moving average. So a simple moving average can also help us remain objective when determining these market conditions. And when you apply this this moving average, you can still identify visually your support and resistance. You can have a comprehensive understanding of Japanese candlesticks, but if you apply a very straightforward, simple moving average to the chart, and you can do so on all of on any MetaTrader 4 platform, you can generally sort of identify, and don't forget this is the average moving average of each candlestick over a certain period or a certain number of candlesticks, should I say. And as you can see, you should derive at the same conclusion, which is that this market is ever so slowly drifting slightly to the downside, but is very, very much range bound, because we're getting prices breaking above the moving average and below the moving average. And this is happening on many, many occasions. And that's why a simple moving average can assist you with being able to remain objective about what is truly happening with this market. And we can see in this moving average that price is trading through it on many, many occasions. And that is obviously a good thing for range-bound traders. It can provide them with potential opportunities to look to sell the highs and buy the lows. And this is just another technique that can be used to assist you with market conditions. Okay, so moving on to price cycles and market conditions. Price cycles can also be used by technical traders to support the identification of market conditions. There is cycle theory, and it asserts that cyclical forces, both long and short, without doubt drive price movements in the financial markets. Price cycles can be used to anticipate turning points in a particular market. These turning points can often be identified as periods of consolidation or clearly defined indecision, effectively allowing the market to pull back. So do not expect cycle analysis to pinpoint reaction highs or lows necessarily. Instead, cycle analysis should be used in conjunction with other aspects of technical analysis to try to anticipate these turning points to a greater degree. So to explain this in a little bit more detail, price cycles can also be used by technical traders to assist with the identification of market conditions. And I just want to share this chart with you. This happens to be an S&P 500 daily time frame. And you can see that the time frame along the bottom. This is over the last 4 years. And you can use price cycles, and it's a well-known price cycle with regards to the S&P. Now, there's a couple of caveats to this because this is a more recent chart. There's been a number of developments within markets like the S&P 500, which has changed what used to be a little bit more reliable price cycles. But nonetheless, if we roll this on, there's just a MACD down the bottom of this particular chart, which you can reference as well. And what this particular chart shows is a typical price cycle that you may experience in the S&P 500. And the principle of the price cycle in the S&P 500 is normally between November and April, you're likely to see prices push higher. And from May through to October, you're likely to see a price cycle where you're likely to see prices squeeze lower. Now, these can move to varying extents, which is why it's important to make sure that if you're conducting price cycle analysis, that you are combining it with other more reliable forms of analysis. But nonetheless, in each of these sections of the year, you're likely to experience prices pushing higher, and you can see that in 3 out of 4 out of these periods. Even though this middle one here has experienced a significant pullback, it has spent the majority of the time retracing that particular pullback. Now the same applies from the upside. So it has been historically expected for prices to look to move lower during this particular cycle, and as you can see, it doesn't always ring true, but it is important to know that price cycle analysis should be combined with other methods of technical analysis. Okay, so that's just a little bit about price cycle in conjunction with market conditions. So let's move on to how to incorporate market conditions into one's personal trading plan. So the first thing to do is for you to decide the type of trader that you are. So do you prefer to trade ranges, breakouts, or trends? That's the first thing, because obviously there's multiple opportunities depending on your time availability and things of that nature. More experienced traders, however, can trade multiple market conditions as well. And then it's just a case of looking to get really good at identifying the unique characteristics of each of trading that particular style. So whatever approach you want to adopt, whatever fits your personality and your capital and your time availability, then focus on the key characteristics of that style. Taking on board obviously the time frame that you would like to trade, and of course your tolerance to risk as well. So to just finish with a couple of personal trading plan tips. Identify the market conditions before executing a trade, something most new and inexperienced traders really struggle with. So please make sure you can do that first. Identify those market conditions before you execute a trade. So i.e., for example, don't just jump into the markets blindly. Now, a basic trading methodology should look to revolve around things like decide what markets you would like to trade, which is trade selection. Then identify the market conditions of that particular market. And once you've identified that, and this is how it fits into a personal trading plan, then what you can do is focus on the trade setup characteristics. So let's say we are a range-bound market. We need to set up the characteristics of seeing those top edges and looking at the Japanese candlesticks or whatever indicator you may be using, or whatever form of technical analysis you may be looking to adopt. Look at those characteristics and see if that trade conforms with those characteristics. So the more criteria that is reached, the more confidence you should have in that trade, and the more consistent you should become at trading those particular setups. Then your approach needs to focus intently on trade entry. What price are you actually looking to get into that market? And of course, trade exit as well. So we're talking about risk management and making sure that you always draw that line in the sand in terms of making sure that you mitigate risk, obviously as quickly or as well as you possibly can, and really have a strong focus on protecting your capital. And then the final part is obviously the trade management side. So which will hopefully lead to a successful outcome for you. So within trade management, you're talking about, can you mitigate risk? Can you look to book in profit in that particular trade? Should we be looking to cover the position or take profit? So whatever the case may be, effectively you're managing that trade as effectively as you possibly can. But this is just an example to just show you how identifying market condition fits in with an overall trading approach. Okay, so that just about concludes this particular webinar. So just to review, we've introduced market conditions. We've looked at the 3 different types of market conditions. We've looked at the importance of looking at different time frames. We've looked at some techniques to objectify market conditions. We looked at price cycle and market conditions as well, and just finished there with how to incorporate market conditions into one's personal trading plan. So all that's left for me to do is to thank you very much for joining us on this latest installment of courses on demand, which have been brought to you by Forex Academy. We hope you enjoyed it. We hope to see you soon. So do take care, and we'll see you soon. Bye for now.